We got Ridham Desai now joining us from Morgan Stanley. Ridham, good morning. Good to have you on the show. Anuj this side. What do you make of the kind of market mayhem that we have seen over the last couple of days? And do you think we've seen the worst of it, or some more pain is left in the system?
Yeah, hi Anuj. So I think, firstly, I think we need to distinguish this from, previous market panics that we have seen over the last 6-7 years. So, if you circle back to say July or August of 2013, there was an India-specific problem that India was dealing with. Our current account deficit was wide, fiscal deficit was high, real rates were negative, inflation was high, and we needed to respond to a global problem. This time around, I think we are actually sitting on pretty good macro fundamentals. We have brought down our inflation, and I think it's sustainably falling. Real rates are positive thanks to a lot of good work done by the Reserve Bank. Thanks to a lot of good work done by the government, the fiscal deficit is under control, and if anything, it's actually surprising us on the downside. And as a consequence, the current account deficit is in balance or slightly negative. Domestic saving is back in financial assets. So India has more or less rebalanced its economy. The rest of the emerging world, and I think this is primarily an EM problem that we're dealing with, not a DM problem as much, is actually facing a lot of problems. It is, I think, broken in terms of growth. It has got macro issues on the external side. Some of them have internal problems. So what has happened is, if you look at India since, say, May, and probably a lot of people have not, taken note of this, but up to yesterday's close, India had delivered, and I'm including yesterday's price fall, had delivered a 20% outperformance in a matter of just 3 months. So it is like the last man standing. Markets elsewhere broke down, and I think then you come and sell the biggest outperformers.
So
you
Ridham,
can see inside Indian markets as well right now.
Sure. That point is taken. So the follow-up to that is that in that case, would we see more capitulation in India itself? We've started to see, for example, in India stocks like IT and pharma sell off. That normally is when people, tend to just preserve their profit as well, even in cases where they have made profit. So do you think this kind of trend is going to continue? And are we at the last stage of panic in the emerging markets and including markets like India?
So I don't know about the EM problem, because I think EM has got a fundamental issue. So it's not just a technical issue. I don't think India has a fundamental problem. And the way the market is behaving, say, last afternoon and today, it would seem like, we are now capitulating and therefore approaching the end. Now, those things are always difficult to tell, and it's hard to tell, exactly where it bottoms out. But I think as the volatility subsides over the next few days, I think we'll probably look back and say, yeah, that was the bottom of the market. So I feel that, we have given a reasonable correction. We've given up some of not a lot of the outperformance, a little bit of the outperformance. Our relative valuations have come down slightly, not a lot. But our fundamentals are intact. So I think India is okay. And at some point in time, investors need to re-engage. Timing the bottom is always going to be difficult for anybody.
Okay, Ridham, your point is taken that India is the good boy in an otherwise troublesome classroom. But what is the sense you've made of the global markets itself? How much more will they discount the Chinese slowdown? It appears, yes, that they overestimated the EM growth story, and particularly the Chinese growth story. But hasn't that been discounted enough now, the negativity?
Yeah, possible, Lata, actually. I wouldn't say that this is the time to turn bearish and, sell out of global equities, for example. Not that I'm the expert on it. But that, of course, also doesn't mean that markets are about to go up a lot. So I think it will be very selective. And wherever there is growth and there is stability, I think those are the markets that will trade up. That's precisely what was happening, say, over the past 3 months, and that was what India was up to. It was the market with stability and growth, and it was outperforming. And I think at some point down the line, that trade will come back. It's not going to be a uniform uptrade for every market, and there are certain emerging markets which have a lot of work to do in their back room to fix themselves before their markets go up. But it certainly looks like that markets are oversold. In fact, my European team actually put out a note yesterday which basically said it's all house buy signal in Europe. So I think it may be happening with a lot of other markets, which is that you've got some capitulation, and therefore some of these fundamentally strong markets will trough out quite quickly,
okay, but
which I think would include India.
Okay, Ridham, you handle a lot of FII investors. Yesterday we saw a really large sell number. Of course, yesterday we saw the kind of panic in equity markets as well. What's been the anecdotal evidence as far as today's trade is concerned, and do you think there are bargain opportunities right now which the FIIs could be looking at, or are we looking at 2 or 3 more days of ugly sell numbers?
So I don't track that on a hour-by-hour basis, and I'm not sure exactly what type of investors sold yesterday. It was a big number. It was the biggest ever in our history on a daily basis, and I imagine because our market cap has grown incrementally, we will get such record numbers often. But I do think that FIIs are not panicking. I think most investors are staying put. Maybe some of the investors who had a short-term trading call may have liquidated their positions given that some key levels were broken yesterday. But I don't see any investment panic as such. So, FIIs continue to believe that this is the place they want to be invested. I think you have interviewed a lot of investors over the past day and a half, and most of them have reiterated that they are overweight India and they don't intend to trim that. And I think that's also what I'm learning from my clients.
No, that's true, Ridham. Actually, expert after expert we spoke with did tell us that India is the darling for growth. We got some very extolling adjectives from most of them. But usually don't markets sell off till the last bull standing is knocked off?
No, that would apply, Lata, in the event that, fundamentals start breaking down. So I think there's a material difference here. Now, of course, if there is a reflexivity that we must keep in mind, which is that share prices fall, then they start hurting fundamentals. And I can paint a story of how this can all weave into a bad fundamental story in the next 6 months, and that's your doomsday bear case scenario. I don't see reason to go down that path, because I think we have got reasonable macro fundamentals. I think we have a fairly responsible reaction from the government in terms of fiscal policy as well as from the RBI. So with policymakers in that type of frame of mind, I think we should be rest assured that India is okay. And, as this global volatility settles down, I think India will be back up on its feet.
No, I personally don't need convincing at all about Indian macros. I'm quite convinced that the improvement we have seen over the last 24 months is absolutely, a AAA meriting grade. But are the global fundamentals intact? If globally you think that economic growth is much more broken than markets have so far discounted, then we can't be spared in the tsunami. So what is the sense you are making of global investors' view of the global growth story?
No, I think it's not a global growth story as much as it's probably, say, China.
Okay.
And some parts of the emerging world, maybe Brazil or maybe, some parts of Central Europe. So I don't think this is as much a DM growth problem. I mean, DM already had some issues with growth. So there's no incremental growth issue in, say, US or in Europe, except that maybe the strong dollar, as the Fed pointed out, was feeding into some negativity into the US. And the dollar remains strong, and therefore the Fed has sounded a bit reluctant to raise rates in September, which I think became the trigger for the sell-off, which is that a lot of people thought maybe the world is in deeper trouble than we thought. But I don't think this is a global thing as much as it is specific to, say, China and a few other emerging markets, and more so, I think, China. So markets will therefore wait for Chinese reaction. There was, I think, widespread expectation of monetary policy action from China, which has not yet come through in a big way. And at some point in time, if the pain intensifies, then I think China will react, and that will probably act as a trigger to stabilize markets globally. But in my view, if I were to pin it down to one source of problem, it's largely China. It's not global in that sense. But of course, China is a big economy, and like we saw in 2008, when the financial sector in the U.S. had a problem, that problem reverberated across the world. So there is that potential, as I said. If you paint a bear case scenario, you can take that and say the whole world will be in trouble. But it's too early to make that judgment, in my view.
Okay. Ridham, what about sector-specific? We've seen nearly a 10% fall in the Indian markets in the last 4 days. Which sector stocks, started to look attractive, where the risk-reward has now turned favorable for India?
So I think that's happening in a lot of sectors. I would say the banks have turned a lot more attractive. Some of the private sector banks have gone back to where they were a year ago. So they've given up a whole year's performance, and that is a lot of compression in PE ratios because most of them have grown their earnings at high double-digit, high teen growth rate over the past 12 months. I think the industrials look attractive. I think the signals from India are that capex is turning. All the indicators that we see suggest that there should be strong capex in the next 12 to 18 months. And therefore, industrials, I think, will continue to build their order books. So I think the industrials look attractive. I also think technology stocks are good to buy at these levels, even though there is a global growth scare, as we termed it. But I don't think it's so much a DM growth scare, and I think technology companies should be okay. So, and the rupee is, slightly weaker on a nominal basis, which is always good for tech earnings. So I think technology should do well. And back home, I think urban consumption, it's clearly healing. We recently published our proprietary AlphaWise research, which shows that urban consumption has been improving over the past 6 months. And I think that continues to be the case. So urban consumption should do well, and that is why urban consumer companies should also do well. So these are the 3 or 4 places where I think investors should focus on.
Okay. Ridham, so let's talk about the overall market again. We have now fallen 15% from the top. This is the first real correction for our markets in the current bull cycle. Last time we had 3 or 4 such big corrections. What is the risk that we could be at the start of a bear market? I know, this sounds quite scary right now, but given the fact that this has been a different bull market which hasn't had any correction, what is the chance that the 9100 top stays for quite a long time for our market, and what we are in right now could be start of a bit of a bear market?
Anuj, if I knew the answer to that question, then I guess we would not be talking to each other right now. It's difficult to tell, right? I mean, we have to see. I can paint scenarios, and we can come up with various situations where this could have, what we saw in February was the top of the market. It seems less likely to me. I would be hesitant to go down that path. And I would just think that this is a serious bull market correction, which actually started in absolute terms way back in the end of Feb. And we had a correction which took us down to 8,000 and then a rally back to, say, 8,500. And now we have gone back through below. So we've had a couple of falling tops and falling bottoms. So you could call this as a correction which is now 6 or 7 months old. And has produced sizable price retraction as well. So to me, it still seems like a bull market correction. I think it's too early for us to say this is the start of a bear market, but, hindsight will give us perfect vision. I hesitate to think that because I think we've done a lot of macro healing. I think earnings are improving. In fact, on the point on earnings, we just did a bit of analysis for the earnings that ended in June. And if you strip out the PSU banks, if you strip out, a couple of global companies like, say, Tata Motors, and if you take out the metals and mining stocks, earnings for the rest of the stocks in our coverage universe grew at about 17%. It wasn't such a bad quarter. Actually, this was the best quarterly earnings that we've seen in 6 years. So there was a fair bit of momentum that came QOQ. The headline number hides it because we've got some really weak spots, which are largely global and PSU bank related. So I can see that the source of weakness is global, and you can see that on the screen as well. A lot of companies that have global earnings are very, very weak right now. Their stock prices are weak. But going back to your question, I don't think this seems like the end of the bull market. I think this looks like a serious bull market correction, which will afford opportunity for investors to buy stocks.
Okay, Ridham, let me come back to China. The government and the PBOC have taken a series of steps which include reserve rate requirement cuts, interest rate cuts, and that's not helped stem the fall in the Chinese equity markets. So what gives you the confidence that even if we get some policy action from China, it will help in reversing this downward trajectory of the market? Because it seems to be a crisis of confidence, for the, at least in the Chinese markets. So how will some policy action from China actually reverse this trend?
No, so I don't have I don't have that much of confidence because I don't understand the Chinese markets as well, and I think maybe the action taken thus far has not been sufficient. And by the way, this is not about Chinese stock markets. This is about the Chinese economy. I think the Chinese stock market is not such a good barometer of what the Chinese economy is doing. Because arguably, even in the first 6 months of this year, the Chinese economy was still slowing down, but the stock market seemed to be in a different territory, and they were up a lot. So I think they're two separate animals here. I'm more focused on what happens to the Chinese economy, which is slowing down. I think the headline growth numbers probably don't tell us exactly what's happening in what you would call as the old economy of China, which is where all the disinflation pressure is coming to the rest of the world. So I think that's where action is required. It's more on the economy rather than the markets.
What's your guess when the chips are down, or when the crisis has blown over, rather? Do you think that India would get more brownie points for being the good boy? Not just a recognition of inherent fundamentals, but probably some money abandoning China?
See, Lata, on 3 counts, India has already been rewarded handsomely.
Yes.
So firstly is the fact that we are now outperforming emerging markets, even if you go back to Jan 2008. So the entire bear market underperformance has been absorbed in the last few months of outperformance. That's the extent to which we have outperformed. The second is our relative valuations. Actually, it's a little bit worrying because, as of yesterday, our relative P ratio was at about a 60% premium to emerging markets.
Okay.
And only one occasion in history have we traded at a higher multiple, and that was in January 2008. Okay, so we've been rewarded with a higher multiple as well. So we've been rewarded with strong performance, strong multiple, and also strong flows. So what the FII numbers on an absolute basis hide is the amount of relative outperformance we've registered on flows, because emerging market have seen continuous outflows for the last 6 months, whereas India at worst is 0. So in fact, India has seen net inflows. So we've been rewarded on all 3 counts, and I think some of that reward is giving up because of the nature of the correction globally. But I think it will come back. So I would expect India to continue to trade at these premium valuations.
Sure.
In Jan 2008, or in fact even before that, and almost 6-8 months before Jan 2008, the relative valuations had already started worrying us. We were very bearish on Indian markets, and after that I saw the index go up 40% because everything got so overextended everywhere. But this time I don't feel like the relative valuation is a reason to get worried on India, because I think India does certainly enjoy superior fundamentals. So I think you're right, Lata, that reward will come back to us after this correction.
Okay, Ridham, looks like market is listening to you quite carefully. The market has seen quite a bit of recovery as the interview was going on. So the Nifty has seen a sharp recovery, almost 80-point recovery is what we have on the Nifty, trading at 77.50. Ridham, thanks a lot for your time today. Really appreciate your views. That's the big call from Ridham Desai, saying that no, this is still a correction. This is a China economy problem more than anything else, and this is an emerging market, equity market problem. Once it settles down, India would again be a bit of an outperformer. That's the call from Ridham Desai.